Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to turn to silver guru David Morgan of themorganreport.com. David, welcome back to the Kaiser Report.
Well, Max, it's been a while, but it's great to be back. Thank you.
Hey, well, David, if you're on my show, is the bear market in silver and gold over? Is that what this means?
It means it's over, Max. I think it ended last year, at the end of the year, somewhere around the last trading day in November, early December 2015. I've seen enough data now to convince myself that the bottom is in.
All right, now let's talk about the big picture here. So many of the biggest names in hedge funds, bonds, and even former central bankers are saying the economy is on the verge of another collapse, as you and I have talked about would be inevitable, and they are very negative on the way interest rates are going into negative rates. And these negative rates, which were in Europe, they're in Japan, they're coming to America. Can you talk a little bit how negative interest rates have destroyed one of the reasons why people would not own gold or silver, the negative carry cost? David Morgan.
Certainly, Max. I mean, the whole idea of the net present value of money, or everything you learn in finance, really revolves around interest rates. It's what's the future value of money, and the idea is that a dollar today or a euro today is worth more than it is in the future. And then you have to provide an interest rate that makes the loaning of the money worthwhile. So the interest rates determined in a free market environment will provide the investor someone that's willing to sacrifice their capital for a given length of time, be it a year, 5 years, 10 years, 30 years, like in a long bond, and they're willing to do it because the return will be commensurate with what they believe the future will hold. When you go to negative interest rates, just the opposite occurs. It means that you have to pay the holding company, the bank, in order to hold on to your money, and you're guaranteed to lose money. I mean, this is absolutely preposterous. It has no validity in modern day economics, and yet that's how desperate these banks are. So if you move that idea against gold, the big argument from the mainstream is that gold doesn't pay interest. Well, if you're getting negative interest on your cash and no interest on your gold, then which is the better investment? Is obviously gold in that context. So they've really got a problem in several ways. And the other one that we might touch on is this idea of electronic form of money only, and what that might mean to the gold market as well.
Okay, we'll get into that in a second. And but I wanted to touch base on Stanley Druckenmiller, who, of course, very famous money manager, hedge fund manager, worked with George Soros for a number of years, compounded money at some incredible rate of interest. He's one of the Hall of Famers, I guess, in the hedge fund business. He's saying now basically to get into gold and silver. Now, as are a few other big-time hedge fund managers and money managers, what's interesting, David, is that in the past, these guys would have recommended going into cash or treasury bonds. But I've maintained that once the thing finally blows up, these billionaire hedge fund managers and billionaires around the world are not going to seek safe haven in treasury paper because they're being hit with things like negative interest rates. They're going to go to gold, which has worked, and silver. It's worked for 5,000 years. Why would they not go to gold and silver? And gold is only a $6 trillion market or so, and you've got over a quadrillion in derivatives. If you try to squeeze a quadrillion into 6 trillion, something's got to give, and that something is the price, correct?
Max, I got to apologize. I've got a bird outside of my office here, and for the last couple of days, I cannot shoo it off. It has something in this office that it wants. I've closed the blinds.
They want some silver, David. They want some silver. They know you've got silver in there.
I guess that's it. It's trying to get something shiny off the desk and take it. I'm not sure what's going on, but I apologize. It just keeps tapping, and I've tried to get rid of it. I can't. But anyway, I'm on to your question. You're right. Gold is the ultimate answer, and what's so interesting to me is the perception of bonds being a safe haven. I mean, we have a failure that is absolutely going to take place. It's mathematically certain. So you either fail on the currency, which means that you hyperinflate it away, like it's going on in Venezuela, or you default on the debt and you say, you know what, you're going to get 50 cents on the dollar. We can't pay it all back. We're broke. But the latter is admitting something's wrong by the places of principalities in the empire, as I call it. And the other way is just that is not detected by most people. It's like, well, something's wrong, and they understand the word inflation. They look at the result and blame that as the cause, and it's not, of course. But so you're right. To be succinct, Max, the peak of the bond market, and we talked about that, I think, last time I was on your show, is imminent. Maybe it's behind us. It's hard to call, but there will be a day when the bond sell-off, which has really taken place. I mean, China was able to off about $1 trillion worth of U.S. debt in a very short period of time, relatively speaking. And yet interest rates really didn't change. That's absolutely impossible. All markets, if they're free markets, move up and down based on supply and demand. So if there's a lot of demand for gold, the price is going to go up. If someone dumps a bunch of paper gold on the futures exchange, the price goes down. I mean, we've seen that over and over again. That's how markets work. But yet in the bond market, it seems to be impervious to the laws of economics. And this is because of the Exchange Stabilization Fund and the ability of these banks to basically circumvent the free market enterprise system, where interest rates would be moving reflective of how much demand or how much supply is available. So back on topic, the point I really want to stress is that the bond market is something that is not safe. It's the last place you want to be at a given point in time in the future. And I think the future is a very near future. And that's why people like Druckmeyer are leaving that market, or at least enhancing their gold position, because once the exit starts, as you said, even if you take the value of the derivatives at a quadrillion, and you say it's leveraged at 100 to 1, so you've got what, 100 billion, or even in real value. I mean, the idea that the notional value doesn't mean anything is ridiculous, because anyone that's ever traded futures like yours truly, and you put up maybe a 5 to 1 ratio, you put up $1,000 to control 5, for example, or 1,000 to control 10. It's wonderful when it's working for you, but you know what? If it goes against you, you all of a sudden could be on the hook for the 10,000. It does work that way. So the counterparty risks are so great, so tremendous, and they're not that widespread. They're really all interconnected because all the banks are interconnected.
All right, let me jump in there for a second. And if you've just joined us, I'm talking to David Morgan here about silver, and the noise you hear in the background is an intrepid bird trying to knock its way into David's home and steal some of his silver bullion. And we'll do a separate show on this coming up soon. But anyway, so you're talking about the silver market and the gold market and the silver market and the internals, the machinations, the technicals, the commercials, the traders. And I wanted to talk about, at the moment, there is a huge position in the silver market. Hedge funds are the most bullish position on record. Usually at these junctures, there's a pullback of some type. From the internals going on there, but we've talked about this before, David Morgan. At some point, this game of flooding the market with naked shorts and paper silver, it doesn't work anymore, and the demand for physical silver overpowers these guys, and you see a huge breakout on the upside. We saw it back, 5 years ago, crash JP Morgan buy silver. We took the price up to $50 an ounce based on physical demand. But then JP Morgan and those bankers came in and they flooded the market with, by some estimates, $500 billion worth of fake, naked silver bets. And they pushed the price back down into the teens. Are we going to see now finally a breakthrough and a breaking up of the cartel, David?
Well said, Max. And don't forget, the exchange, the COMEX, raised the margin requirements 4 or 5 times to get the price down. So not only did they have a pocket full of bogus silver or derivative silver, they also upped the margin requirements. So people that were, long silver had to pony up more and more cash, like I just said. Is it going to take place? Absolutely. When is the big question? And of course, no one knows. Obviously, we're a lot closer than we've ever been. As far as specifically, I put out in my look over my shoulder for the website members that I saw a peak at $18 silver and $1,300 gold. And as we're doing your show, Max, so far I'm right. Based it not only on the commitment of traders, the funds have a disadvantage over the banks. The banks are the commercials, and even the commercials, which are truly commercial, like a commercial in the wheat market would be a wheat farmer, a wheat grower. A commercial in Cotton would be someone that grows cotton. A commercial in gold and silver would be a mining company. The problem with the mining companies is all the big ones, especially the conglomerates, are all give their book or their trading activity to a major bank or a bullion bank. So the bank not only knows what the mine's going to produce, they probably have a lot of over-the-counter derivatives that go to, let's say, the refiners and the smelters and onto the market. So they have that part of it. They also know what their quote-unquote hedge book looks like, which they can multiply. And they've got the backing of a central bank, which could give them infinite money. On the other side of the trade is the trading funds that you just referred to, Max, and they're out of money. So when they run out of money and they can't go long anymore because all of a sudden you pull out your pockets, they're empty. Well, what do I do? You have to sit and wait. Now it's like a poker game. If I'm sitting there and I'm all in, and you're sitting across from me, Max, and you still have a ton of chips and you start edging it in, I've either got a bar, there's nothing I can really do. So I've got to wait. So this is where it looks like we're at in the commitment of traders. And that's why I called the point I did and said, I think we're going to get a pullback. But again, I want to emphasize for everybody, and I don't want to be unclear, the game continues, but it will end. And it's going to end when someone says, you know what, they call the pot and say, hand it over. And the silver can't be delivered in time, the gold can't be delivered in time, or they're required by the COMEX rules to take paper instead of product, which could happen. I doubt that's the way it'll fail, but it could. But there'll be some discrepancy that takes place, and we've already seen so many over the years. And this is what's so upsetting to someone like me, and I'll speak for you, perhaps you as well, Max, that, Ambro comes out, these gold accounts and was it ABM, Ampro? I can't remember the exact name, but they said, no. You have a gold account and it's physical gold, but you have to take paper. And then, of course, what happened with Corzine. And all this has gone on, and yet we still see the markets plugging along in this paper paradigm. It's really quite upsetting, but it won't go on forever. In fact, I don't think it's going to go on a lot longer. I'm sorry about that. Bird is getting more anxious. I think I should probably take these silver bars off the desk. Go ahead. Sorry.
Yeah, he wants to get into the show. Anyway, so we've only got about 30 seconds left, and I don't know if we're going to have really enough time to talk about, you mentioned electronic money there, but I guess we'll try. In 20 seconds we have remaining, what was a comment you want to make on electronic money?
Well, that I don't think it's going to work. I think it's going to put people more into the gold and silver markets because it's the only money that's outside the matrix. And as you said, it's the only money of 5,000 years of history that people trust. Trust is breaking down in the system across the board from the big boys like Druckenmiller.
All right, we're going to have to cut it off there, David. But I want to pick this up with you again in the short term and talk about that aspect. It's very interesting. David, thanks so much for being on the Kaiser Report.
My pleasure. Thank you.